Most business owners treat working capital as the money that they can see coming in and out of their business on a daily basis. But when selling a company, we can treat working capital in a more scientific way to get a deal over the line. In this video, I'm going to cover the importance of working capital in a transaction and how the typical method of calculating it occurs. My name is Kieran McKeever, and over the past half decade, I've worked at the third largest professional service practice in the world. I've been advising entrepreneurial businesses, helping business owners making between £3 million and £15 million worth of profit achieve a first-time exit. Now, working capital can be defined as current assets minus current liabilities, and it's the fuel for the business to keep running. With it being a very key negotiation point in any transaction, it's important we understand how it functions. For most businesses, working capital will fluctuate quite a lot throughout the year. For example, for an e-commerce business, they will have very high levels of trading in the Christmas rush, so have a lot of debtors and stock during this period. But in January and February, they're much quieter, so working capital will be lower. Same business, but a different time of year means a very different working capital. If you were a buyer who was buying the business in February, you wouldn't be too happy because you are left with a lot less stock on the balance sheet. So in a transaction, we have a solution that looks at what is the normalized working capital throughout the whole year, i.e. a 12-month average. This forms part of a lockbox and is the method most advisors use to find a fair way of agreeing working capital. Let me explain the concept. So step one in a lockbox is fixing the balance sheet at a certain date, or locking the balance sheet as you will. We pick a specific date and then measure working capital at that point in time. The next step is to agree a method to which we calculate a normalized level. In the example, we're using a 12-month average. We call this the target, and we can see it is at 456. The final step is simply to compare and adjust these two figures. If the actual equals the target, then no adjustment is needed, but this is very rarely the case. If the actual is less than the target, then the seller's headline price actually reduces and therefore shows the importance of its calculation. And finally, if the actual is more than the target, then the inverse happens and the seller receives more money. A lockbox is designed so that the buyer gets a fair value of working capital to trade with after close. But what happens when we fix the balance sheet at that date and completion is a number of months after? Well, in many transactions, there can actually be a few months in between, and so a profit ticker is a solution to ensure all profits made between these months are passed to the seller instead of being inherited by the buyer. In this example, you can see in January to March, the business generates 100k worth of cash profits, and so that value is added to the seller's final check. The profit ticker is used to ensure the seller receives that money. So what are the key takeaways here? Well, number one is that working capital fluctuates quite drastically throughout the year. And number two is the lockbox is a method of addressing this issue so we can transact at any given time. Finally, the profit ticker protects the seller's earnings between that lockbox date and completion, ensuring that we transact with a fair value.